What's going on, my fellow physicists and quants? First of all, I just wanted to say thank you so much for the 250 plus downloads on my paper. I didn't expect it to be that successful in 2 weeks. But yeah, you guys were really well receptive. You guys received it really well, so just wanted to thank you guys for that. And yeah, so we're just gonna dive deep into the actual model now, and the arguments in the paper. Just treat this as kind of a casual reference for just the outline of ideas, just from the source, right, from me, right, because this theory kind of originated from my own speculations, and embedding of the capital asset pricing model into the Fokker-Planck equation. So let's begin. We're just going to explore kind of this new idea that unifies the classical equilibrium-based view of financial markets with a more non-violent, violent non-equilibrium dynamics of financial crises. So we're going to show that just applying the principles, specifically using the Fokker-Planck equation, we can understand phenomena like flash crises, and not just like as some random external shock, like, oh, this is just a random, failure in all the high frequency trading firms, doing all of these things, but actually more so as a predictable phase transition inherent to the market itself. And so we're going to make some physical analogies of like phases of matter to like phases of the market, right? If the market's in different, states, and it's going to have, levels of criticality and show these kind of scaling laws. And so the heart of the paper, right, is these findings, and that's why it's on the front, right? So as the market approaches a crisis, we state that, and we quantify this by the smallest eigenvalue. Let's call this lambda sub min. This is the smallest eigenvalue of the covariance matrix of basically returns of all the assets. As this approaches zero, right, we find that asset returns are risk premia. This is gamma sub d, and entropy, thermodynamic entropy production, right, the change in entropy. It scales at these vastly different rates, right? This is the order of the terms. I don't know why it has theta. This should be an O. But yeah, it was kind of late when I made this. But yeah, this is just a fundamental asymmetry between these parameters that is kind of key to understanding this observed paradox in modern financial crises. And I'm going to get into kind of the literature and everything. Well, not so much the literature, but more so the derivative kind of concepts from the literature that I explore, specifically in the paper. So if you need specifics, reference the paper. If you want to see derivations, reference the paper. But we're mostly this is a conceptual outline of what I'm presenting. So the fundamental schism in finance, right? We claim, well, we know that modern finance is built on the schism, right? On the one side, we have an elegant equilibrium model of the economy, pretty much. And these models, like the capital asset pricing model, or CAPM, or modern portfolio theory, all of these things kind of stem from this powerful kind of tool of describing stable market conditions. And this is assuming that efficient markets, have Gaussian returns, or in other words, normal curves, right? These normal curves are the, returns everywhere in the market, invariant of time scale. It doesn't matter how far away, you zoom in or zoom out, hourly, daily returns. You should, theoretically, if the market is purely efficient everywhere, it should just be a normal distribution. That is a key argument in the capital asset pricing model. And not just in the capital asset pricing model, but in the efficient market hypothesis. So mathematically, that's what that means. Really, when we think this way, we're blind to crises. So here's the capital asset pricing model formula, which is, I'm just going to say CAPM. Okay. The CAPM formula is the expected value or the expected returns, right, of the market. Theoretically, should be we should reward some kind of premium or some kind of premium that we enter into the market. The market should reward that in terms of how much it correlates with the overall market itself, in theory, right? And usually, typically, we calibrate this against the S&P 500 because it's a market cap weighted index that is generally indicative of the economy. Not so much GDP growth, but more so just the economic state of the United States. And so what we do is we say the risk-free rate, right? Whatever I could buy, the interest rates of a risk-free bond that I could just, assuming that the U.S. doesn't default on its debt, this is the risk-free interest rate, plus beta, which is kind of a measure of the covariance of the market, basically the systematic risk, right? Or sorry, the covariance of the asset with the S&P divided by the variance of the S&P, or the variance of just the overall market, whatever proxy you choose to use. So there's a little bit of unclarity with this too. It's more of a theory, right? And then this is the returns, the historical returns of the market minus the risk-free rate. This would be the market risk premium. Or actually, I can't remember if it's the market risk premium. It has something to do with this term. I don't remember if it's this times this or if it's just by itself. But either way, right? This is blind to crises. We're definitionally blind to the idea of markets going into crises when we view the world in an efficient market, because a very efficient market assumes that the market is efficient, and if it's not efficient, then we get weird returns and return distributions with heavy tails or skewed tails or volatility smiles and smirks, and options pricing as well. We are inherently, when we assume equilibrium models, we are blind to financial crises. And so let's look at this side, right? On the other hand, the empirical reality of a crisis, events like the 2010 flash crash, I would definitely look that up if you're not familiar with it. But it was like a couple. I can't remember the time frame, but it might have been like an hour or a couple seconds. It's just a smaller time frame. We call this a flash crash because the market the liquidity evaporates and the correlation between all of the assets just completely breaks down, right? So this beta becomes meaningless. And that's kind of what on my LinkedIn post, I talk about beta, how there's an anomaly during, different times where the VIX, it'll shoot up during a particular time, and the correlation between all of the assets, that whole matrix, the eigenvalue starts approaching zero, and that's kind of what we really are trying to capture. But this leads to kind of a volatility paradox. And you might be wondering, what is this volatility paradox? I mentioned this a little bit in my paper. I don't mention it too much, but basically the core paradox is that these events feature, these events here feature relatively bounded price movements. So the S&P might just fall, 9%, right? Some politician says something, and then or some, event happens, or, something that we don't know how to explain happens, right? And we observe that the market falls 9%. We see unbounded systemic distress. So we see bounded price movements, but unbounded systemic distress. So we see in the VIX, right? We can realize, spikes by 400% or more during crises. And so our goal really is to explain this disconnect from first principles. That's the whole goal of this paper. And I want to make that really clear. We're trying to attack this paradox head on. So let's construct a tripartite of postulates about the market. These are new assumptions that I'm conveniently making. The first is the postulate that there exists such a stabilizing force that is driven by arbitrage. We let arbitrage exist. But when arbitrage exists, we don't allow it to be stable. We say that it's going to try to mean revert back when arbitrage pops up, when a firm subjects themselves to arbitrage because they misprice something, right? Or a hedge fund, prices an option because they didn't calibrate their Heston model correctly, or their Black-Scholes, they're using pure Black-Scholes when, we're in the middle of a crisis, right? The volatility, smile, or the implied volatility is going to look all over the place, right? It's going to be a weird, funky curve, or something parabolic in nature. But either way, right? What happens here is that, people subject themselves to arbitrage because we're human, right? Market is human. It is efficient, but it's human. And a way to see this quasi, efficiency would be to say eventually that arbitrage is going to get arbitraged out by the hedge funds and the high frequency traders and the medium frequency traders. They're going to mean revert it back to that capital asset pricing model, equilibrium. That's the first kind of stabilization force that we have. And this data would encode kind of the intensity of which the arbitrageurs are arbitrageur, whatever. It's a funny word to say. But the arbitrageurs, pulling the system back towards a capital asset pricing model like equilibrium. I mean CAPM equilibrium. I need to start saying CAPM more. But yes, the next postulate, okay, is the destabilizing force. And if you have any questions about anything, please share them. It's going to make my algorithm, it's going to make my algorithm really happy. And, it's just, I also am happy to answer the questions. So don't be, intimidated by this stuff. Even if you don't have like a super big background in quant or physics or, econ or any of this, I love engagement. So the second thing is the destabilizing force. And let's say driven by a pro kind of cyclical institutional feedback loop. So we kind of have this up kind of arrow that's indicating feedback. What does this mean? In the paper, it comes out of nowhere, but I want to really drive this home. As market stress increases, right, and the correlation between assets rise together, and more specifically asset returns as they rise together, these different correlations, risk management systems, they're all going to have this kind of, they're going to force these like synchronized kind of selling of these, they're going to try to in synchrony, they're going to try to diffuse this risk, right? They're going to try to liquidate things, and they're going to amplify that initial shock. So the feedback itself is inversely proportional to the smallest eigenvalue of the covariance matrix. And this means that it's becoming dominant in the market. Basically, it's become, this feedback mechanism becomes dominant, as the market kind of becomes fragile. And the third postulate here is the dissipative force. This one is a little bit more of a physical analogy, but I'd like to make kind of a microstructural argument. So we're going to represent this as market frictions and finite liquidity. So this will kind of act like a nonlinear damping mechanism. I kind of, towards the list of different, heat equations in the last video that I did, you can see kind of that nonlinear. It's basically like the absolute value of the derivative with some damping factor. And you can also express it kind of like this too. And we, prevent returns from becoming infinite. Basically, this is a way to make, you can't have infinite returns, right? So this is how we restore this, the destabilizing and stabilizing forces with this dissipative force. You can think about this kind of like a medium. Instead of shooting a gun in space, right? We shoot a bullet. It's gonna go around the earth like super fast because and just go off with a constant speed. But the dissipation makes the speed kind of dissipate, basically. It makes the bullet heat up in the atmosphere, and then it won't be able to to go as far. You can't shoot a pistol and like expect to make like a sniper shot, right? Same thing here. The dissipative force is just gonna be some kind of drag that it depends on the third of the returns, on the cube of the returns through time. So really what we have now is kind of a coupling of all of these dynamics. And so these three forces will describe kind of this rich nonlinear system here that is capable of behaviors that are far more complex than any single force would suggest. And so this is kind of the sketch of the tripartite, forces that I'm imposing here on the assumptions of capital asset pricing model. So next, let's talk about phase transitions. We're going to borrow a concept from physics, water turning into ice kind of stuff, or ice, melting, So we claim in the paper that a crisis is initiated through a degeneracy cascade. This is an initial shock that will cause returns to rise, which in turn will cause risk aversion to increase and correlations to spike themselves. So that's kind of what I explained here. So let me say that one more time. So the initial shock, right, in returns, and the initial shock in returns rises, and then this causes risk aversion. The covariance, this lambda parameter is risk aversion, and then to basically, this is the eigenvalue. It's a stochastic process, but risk aversion is going to increase, and then correlations will spike pretty much. This drives the market's smallest eigenvalue effectively towards zero. And as this happens, a market effectively collapses into a single dimension or a eigenvector. Let's call this V min or mu min, whatever I said in the paper it was. I don't remember. In this state, the explosive feedback force kind of becomes the dominant driver of a market behavior. And so, as we can see in the graph here, to understand kind of this outcome, right, we use a dominant balance analysis in the paper to derive that for a system to remain even momentarily stable, this explosive feedback must be arrested by that nonlinear damping force that we described earlier. And so by setting these two dominant terms equal, we can solve for the characteristic scaling of the asset returns near the crisis point. So this crisis point where this becomes kind of a singularity. And so when we solve for that, we get the scaling, which is proportional to the smallest eigenvalue to the negative 1/2 power. And for the details, you can see that in the paper. And so we can derive kind of these critical scaling laws, from these this analysis of what happens towards that singularity of the covariance matrix, right? When that eigenvalue collapses into one single eigenvector of the market overall. Basically, we get this these scaling laws, and this dominant balance analysis kind of will reveal this asymmetry that's natural to how kind of crises unfold. So while asset returns are bounded, the returns that we realize back with the VIX, right? We'll see these bounded returns, losses and stuff over here. We can check this scaling between the liquidity collapse and information breakdown. They scale much greater. The risk premium here, this for liquidity collapse, it just diverges much more aggressively as lambdas them into the 3/2, and this quantifies this collapse, and we can see that here, where the collapse is a lot more profound as we go, to smaller increments here. So this would be here the bounded prices. This here would be the liquidity collapse, and then here would be an informational breakdown. You can see it just shoots off of this log to log plot. And so this quantifies kind of, the rate of thermodynamic entropy production, which is more of a physical analog, but it measures the breakdown of orderly information processing, and it diverges catastrophically as lambda sub min to the inverse cube, basically inverse cube relation. So this hierarchy here, this explains why. This explains basically just why prices seem contained while the underlying market fabric is basically disintegrating. So we can kind of visualize here this dramatic separation of the scales in a log-to-log fashion. So let's look at implications for financial regulation. The framework exposes the limitation of traditional price-based regulatory models, kind of like value at risk, which are just basically blind to the divergence of risk premia and entropy. So what we do in this paper is we propose a new framework based on 3 pillars. First is the development kind of stress probes. So this would directly monitor lambda sub min as a real-time indicator of systemic fragility. Second is the design of the anti-feedback protocols. And so such an adaptive thing would be like a circuit breaker, but for capital requirements that kind of automatically tighten as lambda sub min falls, counteracting the primary driver of the crisis. So this would be some way to kind of, get this anti-feedback, right, to sustain that feedback force that we assumed, right? And the next would be the entropy circuit breakers. Now, this would halt trading not based on price drops, but a critical threshold of informational breakdown. And so we would target the root cause of a crash. And this would represent kind of like just a general shift in our understanding from the price-based regulation to managing the market as kind of a more physical system susceptible to these phase transitions. And so you'll see like the different phases that I talk about in the paper. I'm not going to get really into it, but if you're curious and you have questions about it, please interact with me through my YouTube. But I would like to formally synthesize everything. So in summary, our core accomplishment really is the unification of a CAPM equilibrium with crisis dynamics in such a way that I made some assumptions. And so, by creating a more complete field theory of market behavior. This work kind of establishes a direct correspondence between financial and physical kind of phenomena as, market regimes act as, thermodynamic phases. And a flash crash can kind of be seen as like the financial equivalence of like critical obsolescence in physics. Further research would just focus on incorporating explicit, networks of maybe institutional networks and topologies of these different ways of thinking, or developing more principles of like entropy-based regulation or, policy kind of concerns. I don't know. There's a lot of different directions that you could go with, but ultimately we frame the financial markets as a dissipative thermodynamic system, and in doing so, we offer a new quantitative language to describe the most complex and dangerous behaviors. So thank you guys for watching so much. I just wanted to again thank you for the interaction with my paper and all of the different reads and comments and even criticisms that were kind of helping me reframe my argument a little bit. But yeah, it's only been 2 weeks, but I've already gotten so many downloads and engagement with it. So just wanted to thank you guys so much for doing that. And I've been trying to get this video up for a while, but I'm glad that I finally, got around to it. So yeah, stay tuned for more. I'm actually, working on another thing that's kind of big. So stick around, subscribe, and help me out, comment, and also join the Discord. Thank you. Bye-bye.